Would you sacrifice a little of your investment return to save on your tax liability? This is a question companies like Goldman Sachs are starting to ask to connect with retail clients like yourself. Jedediah Collins here with the Money Vehicle Movement podcast, where we are making financial literacy a little cooler and hopefully a lot more current. Goldman Sachs began offering investment portfolios on Betterment back in 2016, hoping to attract fees from more quote unquote Main Street investors, small little fish like you and me. Typically, Goldman Sachs is targeted at customers with an average of $70 million invested with them. This door to Betterment opens some of Goldman's sophistication to investors with as little as $10 to start their investment journey. Goldman says it is beginning to structure portfolios to save the everyday investor in taxes. Usually, when you have cash in a brokerage account, the money that is not invested sits in a traditional savings account earning little interest as ordinary income. However, the past 2 years has seen a very large push into holding your cash in a brokerage account in a high yield savings account overnight, which produces a little higher interest rate and, of course, a little more payout for you. This is a good thing, generating a little extra income, except when certain investors start to see the increase in their ordinary income tax. From these investments, the tax hit that accompanies the increase in income has started to become at least a subject of interest and concern. How can you get that interest income without the ordinary income tax hit? That's a question everybody wants to know the answer to. And this is an example of where Goldman in the past has added value for its clients. Goldman plans to sweep, which is when you take that cash in the brokerage account and push it into a different account overnight, high yield savings. And in this case, they're planning to sweep the cash investment into fixed income with tax benefits. Fixed income investments with tax benefits, items like short term treasuries and municipal bonds, would provide interest without the tax from federal or state governments, depending on the investor's current tax bracket and other personalized tax information. Before you think you can become a Goldman Sachs client, understand the bank is not focused on providing you value. They are a bank in search of fees, and these doors, they believe, are going to open up more fees. They did this internally with an offering called Marcus back in 2021, but it didn't produce the fees they hoped, and they sold those Marcus accounts to companies like Betterment. Goldman is now providing options to companies like Betterment who work with retail investors, again, small, normal people, and hope to see their fees continue to pour in from these types of strategies or maybe access to the Goldman ETFs. Again, the hope for increasing fees by offering resources to other companies while not directly working or investing with quote unquote Main Street investors. Goldman Sachs has a rep to protect after all. Question for you: should you follow suit? Should you try these new tax strategies? Well, that depends if you are looking for more of an investment return on your income or if you're looking to save a little bit on taxes. Investments and your overall financial plan are personal. Show people you speak the language of money by understanding what you're investing in, managing the fees of those investments, and even mitigating your tax liability. Keep driving your money vehicle, and we will see you at the next stop.